Welcome back. You tune in to Markets at Noon, and now we have Jitendra Sriram, who's the Senior Fund Manager, Baroda PNB Paribas Mutual Fund, who's now joining us to weigh in on how the markets are really shaping up and what's going to be the way forward. Hi, Jitendra. Good afternoon, and thank you so much for taking the time out. Jitendra, Nifty is hovering around its life highs. In fact, the market texture looks good, and historically, there's an interesting research data that the ET came out with that every time that index resets a previous quarterly high, the benchmark has delivered an average 30% gain over the next 4 quarters. How likely is that? How are we placed domestically? Because as far as global markets are concerned, India has been a net performer. So is it really time for Indian markets to move? And also, since this is the beginning of December, can we expect a Santa rally towards the end of this month?
Yeah, good afternoon to you and all your viewers as well. For the first part that you were asking about, I think broadly, I would say that if I look at the earnings construct for the 2Q season gone by, it is at least showing that earnings are in a state of stabilizing now. Because in the preceding 4 quarters, we had a situation where after every quarter, we were cutting numbers. So the numbers were a little disappointing, to say the least. But now, if I look at the second quarter numbers, the numbers are more in sync with what the street was expecting. So it's showing a bottoming out phase. A lot of these consumption boosters unleashed by the government, whether they were the tax breaks, the GST rationalization, etc., etc. I would expect that you should start seeing the impact of those slowly starting to filter through. So from a outlook perspective, I would definitely be positively inclined. But I think valuations is something that is at this juncture a little, it will take a little time. So maybe the 30% might be a little tad too optimistic, but otherwise, I would say definitely from a drift perspective, I would be more inclined for a positive outcome.
Okay, so that's the view coming in on market, Mr. Sriram. Afternoon, Ashesha this side. Let's get the bigger picture in place now. And India's macros continue to remain very strong. We had GDP data which came in on Friday at 8.2%, much better than what the street was working with. We also have GDP data which will come in later today. Macros continue to remain stable, isn't it? In the light of this, what kind of earnings growth do you expect from India Inc. Going ahead, say in FY27 and 28?
Yeah. So as we look at it right now, see FY26, I think the immediate near term, I think the challenge could be on sales growth because as you are aware, inflation has been much softer. So the nominal GDP print, we are hovering much softer than what we would have liked it to be. So the question is, the real GDP has obviously been far ahead of what we expected and so on. So that's a great number. But the nominal GDP may have a little bit of implication on the sales side. So this year, I would be saying that if we are able to notch up about a double-digit number on the frontline indices, I think that should be a good enough growth. Going forward, I think if inflation moves back to its trend line of say between 2 and 4% kind of a number, and that provides some tailwind to the real GDP, I think we should be able to do the low to mid-teens kind of a number for 27 and 20. So that should be where I would be more comfortable with.
Right. Jitendra, also talk to us about the sectors that you see growth coming in and the next leg of rally. Is it the financials that could perhaps lead the rally in the next leg? What are the sectors that you're bullish on?
Sure. So financials, obviously, the last 1 year have outperformed the market, but I think right now it's a bigger dilemma for the central bank RBI now, because the debate that will be confronting them is that at 8% plus kind of a real GDP growth, do we need to stimulate? See, end of the day, the pistol has a certain number of bullets. Do I need to fire it right now, or do I keep it for a rainy day? Something I think they would be deliberating upon at this juncture, just prior to their monetary policy. So to that extent, it's going to be a little more tricky whether they follow a more nuanced approach to rate cut or go ahead and do a rate cut, or they watch out for where US tariffs stabilize and so on and so forth. So multiple ponderables there, but too much of a good GDP number also brings with it the complications that you may not want to stimulate too much at this juncture. So that's where I think the seesaw will play out in RBI's mind at this juncture, the MPC especially. Going forward, I think from a sectoral perspective, I think there are certain areas that are looking fairly positive. So financials is clearly one area that should do well because I don't see a tight monetary policy here on. At most, it will be a status quo or a kind of a softward bias. So I would definitely be positive on it. The other area that I'm seeing a lot of positivity is around the pharmaceutical space because the kind of opportunities that are coming up in the CDMO space in terms of novel drug discovery and so on, that sector should do well. And the third is the way energy markets, especially electricity demand, is rising the world over. I think the entire ancillary segment and the operator segment can actually do quite well, whether it be power equipment, power T&D plays, all these could be beneficiaries of that. You see huge numbers floating around on the hyperscalers investment into data centers, AI, etc. And you're also seeing some Indian names starting to talk about mega billion-dollar investments in India on that theme. So that could actually play out quite well for that sector as well.
Understood. So that's as far as sector-specific ideas are concerned. But Mr. Sriram, also wanted your thoughts on the kind of FII selling that we've been seeing. From a valuation standpoint, how are foreign institutional investors viewing India at this point in time? And do you believe that the trend will perhaps change and they will start buying yet again in the Indian markets?
Sure. So if I look at the fact is up till now, if I look at last 1 year, rupee has not been the most strongest of currencies. It has been relatively weaker. Even in the last 3 months, if I look at it from being in the mid 88 handle, we have moved to the mid 89 handle. So to an extent, for a foreigner, the main thing is that he is looking at dollar returns, which means that currency depreciation impacts the portfolio. So to an extent, you had the combination of earnings not coming up to the mark and you had a weaker currency to boot. So the twin combination obviously meant that India was not the preferred market within Asia compared to other regional markets. So from that aspect, I think we did see a fair amount of selling. But what I can see now is that momentum of FII sales is definitely starting to come off. So to an extent, I think we are now entering a phase where I think the magnitude of selling is coming off. And at some stage, I think as we reach some kind of stability on both the rupee dollar, as well as our earnings start to stabilize, plateau, and move up again, you should start seeing the interest starting to come back. So from that both perspectives, I think foreign buying should recommence somewhere into the next year. So I would not say that it is something that they have a unilateral one-sided approach. They are also looking at eventually evaluating dollar returns across multiple markets, and they would come back as soon as they find India makes more sense. From a valuation perspective, I think India, given the last 1 year of time and a little bit of price correction, has obviously corrected in terms of valuation. So it's looking a lot more palatable in comparative terms compared to other Asian markets. So to that extent, I think the relative standing also starts looking better.
Right, Jitendra, on that note, thank you so much for taking the time out and weighing in on the markets. We'll let you go on that note, and it's time for us to slip into the short break. Don't go anywhere. After the break, we'll get more updates on the market. Stay tuned.